Yeah, I will continue from here. Well, I was talking about what professional judgment is and how this is important in making decisions, especially when the auditor is giving the audit opinion. Even in other aspects, right from the audit planning stage, where you will be deciding the materiality, audit risk, what is the level of audit risk your client has, which is what we're going to discuss right now. And setting materiality level, understanding depending on the audit risk and materiality, what are the extent of audit procedures that are required to be performed. You will have to also use your professional judgment to evaluate whether the audit or evidence that you've obtained is sufficient and appropriate, and you'll have to apply your audit professional judgment in understanding the management's judgment in applying applicable financial reporting framework, as well as drawing conclusions based on the evidences that you have obtained, which is nothing but your audit opinion. So let's quickly look at how different is audit risk from business risk, because in this paper, business risk is also a small segment that we cover, and it is also examined in your AA exams. Business risk is, to put it very simply, it is any event that affects the company's profitability. Event that affects company's profitability, right? So it could be non-compliance to laws and regulations. It could be uh, non-availability of raw materials, which is going to affect your production and then your sales. It would be any poor quality services provided. It could be any adverse media comment which has had an adverse effect on the company's reputation for whatever reason, because of poor services or employee dissatisfaction, employee harassment, and not being conservative about environment and neighborhood. So anything because of any of those reasons. Which is why we, in order to mitigate business risk, we need to have something called as internal controls, which is also a very heavy topic in this paper, however, not covered in this demo session. So that is what is a business risk. Now, what is audit risk? Audit risk is from the auditor's perspective, whereas business risk is from the management's perspective, okay, point of view. Audit risk is from the auditor's point of view. So, what we really try to look at is, are we providing the right opinion? Because that is what is the risk from the auditor's perspective. If we do not provide the right opinion, we will be accountable to our shareholders, because they are the ones who have appointed us. 90% of the time, the auditors are appointed by the shareholders, because we need to report on the credibility of the financial statements after we have audited it. So, the risk of giving the wrong opinion is audit risk. And we need to assess audit risk in three categories. You have inherent risk, control risk, and detection risk. Okay? And that's what audit risk is comprised, like it is a product of these three types of risk. Now, inherent and control risk are something which are outside the control of the auditor, and I will tell you how and why. Whereas the detection risk is something which is within the control of the auditor. So once I tell you what they are, you'll be able to make sense as to why these two are outside the control of the auditor and why is this within the control of the auditor. Because inherent risk is something which just exists. You can't do anything about it, right? They are just there because of the nature of the account, simply, or because the nature of the industry your client is into. Okay, like I can give you an example here. Well, I would like to go to that slide because we don't have sufficient space. So you can see inherent risk. We can come to the meaning a little later after I have explained what it is exactly. So they, like I said, it depends. It just is. It just exists. It is inherent. It's inherent, either because of the nature of the account or because of the nature of the industry, right? Or the kind of business it's into. Like if it's a fully cash based business, then inherent risk is likely high. Nature of account, I can give example here, is revenue, inventory, non-current assets. These are accounts which the management generally likes to overstate, because of obvious reasons. They like to show they have better assets and better profitability, better income generating capacity. So that's the nature of the account. It's inherently, they have high inherent risk of being misstated. Because of the nature of industry, yeah, if it's into retail business and it has a lot of cash dealings, again, there are chances that there are possibilities of theft, fraudulent activities. So again, chances are that your financial statements may not be appropriately stated. So inherent risk for such companies are usually high. Again, if it is into a jewelry business, we know the precious stones like diamonds, rubies, or gold for that matter are commodities for which the prices keeps fluctuating every time, and an inventory valuation for such kind of businesses can be really complex, and which is why there is a high inherent risk for such type of industries and accounts, right? So, and if it is a client that is Google, a company like Google or Apple or Samsung, which is heavily dependent on IT based services, okay, even they are having a high risk, because the nature of the industry itself is technology related. So we know that technology can become obsolete very quickly if they don't do something about uh, their research and development, or if their research and development is not so rigorous, right? So such areas have high inherent risk. And why do the auditor have to consider the susceptibility of such a risk? Because they want to see if they have to perform more audit procedures. So this is how it goes. If there is a high inherent risk, the auditor will have to design appropriate procedures according to that. Moreover, they also have to design more audit procedures. They have to do more testing to ensure that the risk is kept at minimum. That's the objective at the end of the day, right? So if you look at the meaning here, it simply says that it is a susceptibility of an assertion about a class of transaction. The class of transaction is nothing but your statement of profit and loss, the account balance, which is nothing but your statement of financial position, or disclosure to a misstatement that could be material either individually or when aggregated with the other misstatement before consideration of any related internal control. So you don't have any internal controls taken into consideration here, because that is covered in separate heading, which is control risk. We're going to cover that next. That is what inherent risk is. Okay, it's affected by the nature of entity, the regulations, and all the examples that I gave you earlier. Coming to control risk arises when your internal controls are not working effectively. So just some time back, I told you what business risk is and how we need to have internal controls, right, to mitigate the business risk. So, when the internal controls, sorry, not IR, should be IC. I'm sorry if I'm using too many short forms just to save some space. And I generally tell the students to take down the notes while I take the live sessions. So I don't think they have any issues, because they usually don't have issues, is what I would like to believe. They usually kind of understand and take down the notes, and if they're not following, they keep asking me during the live session what the full forms are. So we are kind of clear there. So yeah, I was talking about internal controls. So when the internal controls are not working effectively, are not working effectively and efficiently, then we will have to say that the control risk is high over there, right? Or when the controls are very weak. On other words, we can say, in other words, weak internal control. So that brings me to understand what internal controls are. It is a very different topic in this paper, but I would like to cover a little bit over here, because we can't otherwise understand control risk. Okay, so internal controls are actually some sort of protocols or some sort of rules right? Or standard operating procedures, SOPs, that we normally call in corporates. They are a set of protocols that needs to be followed. Otherwise, your entire business and operations can go haywire, right? For example, you need to have a swipe in, swipe out, some mechanism to kind of monitor the employees' log in and log out time. So some companies have biometric sensors where you punch in while you get in and get out. You have to punch out. That's how it is in few places here in India. But in MNCs that are here in India, you can see that they have some ID cards. Every employee has an individual, unique ID card is allotted to themselves, and they have to kind of swipe in, swipe out whenever they get in and get out of the premises, and that records their attendance and the number of hours they have worked. Similarly, having CCTV cameras, having an escort to for a visitor who has come there to meet the partner of the client or some delegates. So you need to have an escort. You can't just let any third person enter the premises of the client just like that. Having a visitor's file, and when if you talk about warehouses and inventory, you have lock and key arrangements. When you talk about passwords, like employees given access to the computer systems of the companies, that they are password protected and stuff like that. So these are different type of internal controls. I can go about talking about it, but since we're only focusing on audit risk, I have to keep it very crisp at the moment. So you have internal controls even for areas like purchases, sales, cash and bank and stuff. So you can see that one of the most important control in cash and bank system is to maintain monthly bank reconciliations, and they have to also be reviewed by a manager. That's the internal control. But when the monthly bank reconciliations are not reviewed by a manager, that means there is a control risk. There is a control when we study for purchases in the purchase system. They say that the purchase invoices must be always matched with the goods receipt note. So these are two more most important documents in the purchase system, and they need to be reconciled from time to time basis. But if they are not done, then there is a control risk. Computer passwords are not changed regularly. That's a control risk, because if they are kept the same for a really long time, there are chances that somebody may be aware about your credentials and they will try to use it to their advantage. So things like that gives rise to control risk. It's very essential that the auditor also understands the level of control risk so that they can design their substantive procedures. So when the control risk is high, usually the approach that the auditor does is that their substantive procedures or the substantive testing will increase. And audit procedures are classified into two: testive controls and substantive procedures. So because you can't rely on the controls, as you have assessed your control risk to be high, your substantive testing needs to be increased. So that's how it balances off. When you can't rely on the controls after you have performed the TOC, you have to increase your substantive testing. That's always the approach that the auditor will have to take. So because now you know the meaning of what control risk is and what inherent risk is, we now can understand and relate to the very fundamental thing that I told initially, is how these two are outside the control of the auditor, and they together are called as risk of material misstatement. That's the other audit jargon. Now coming to detection risk is this is completely on the auditor. If the auditor does not do a good job by doing proper audit procedures, by applying adequate audit procedures, if they do not do their job well, if they are negligent of their duties, if they are very careless about their work, if they have not selected samples appropriately, then there is a detection risk. Okay, so a detection risk arises that the auditor will not be able to detect a misstatement that could possibly exist and also could be material, whether individual or in aggregate. Okay, so this, like I said earlier, this is the only component of the audit risk which the auditors have control over, and they are classified into two. You have sampling and non-sampling risk. So sampling risk is if you have not selected the correct samples, you've selected wrong samples, you do not use the sampling methods. So we have a standard in auditing which teaches us that there are few statistical methods that can be used and which will help to reduce auditors' bias if we follow those sampling methods. So if we have not selected the right samples, or if we have selected the samples that are not representative of the population, then we again representative of population, then we do not again we have a high detection risk there, right? If you have selected wrong samples, incorrect sampling methods, or we did not pick up sample based on the sampling methods given to us by the standard, we selected samples which are not representative. So those are certain ways that sampling risk can arise. Non-sampling risk, certain circumstances, is if you are employing a very inexperienced, a fresher, maybe an intern possibly, to a very complex area. Okay, you're giving an ACCA intern who has not completed all the papers, who's just started the training. You're giving that person to do audit of deferred taxation. Now, deferred taxation itself is a complex accounting process, and it ideally needs to be done by a senior. But you're giving it to a junior person. That is a non-sampling risk. Then you do not have supervisors reviewing the work, the audit supervisors or the audit managers who don't review the work from time to time. That again gives rise to non-sampling risk. So, there's a list that I have put up. Lack of experience, time pressure from the client, financial constraints, that means you do not have adequate number of audit team members, poor planning, if it's a new client again, or lack of industry knowledge. And the other two examples that I also said can be added to the list, and we have already spoken enough about sampling risk. So this is a theory aspect, but the kind of question that you can be expected is like this.